Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Hello and welcome back to Expert Money Matters. I'm your host Georgina and it's time for our weekly market update. At Chase Buchanan we are constantly monitoring the larger market movements worldwide, and we know these dynamics often create uncertainty, but they also create opportunities. And for us, providing clarity and peace of mind for our investors is paramount. To help navigate this, we produce an insightful weekly email titled The Weekly Market Update. We've taken these latest insights and using a little bit of AI magic, brought this content to life in audio format. This means you can just drive, hike, garden, relax at the beach, or even cook something delicious and just listen. Here is your weekly market update for February the 4th, 2026.
Good morning, or good afternoon, depending on where you are. It can feel, at times, as though the opening of this weekly email is stuck on a rinse and repeat cycle. Another week of big headlines, some extraordinary volatility in individual stocks and even single assets, and yet remarkably limited movement at the overall index level. If we look back at January alone, we saw the extraction of a head of state by the United States, a threat to the sovereignty of a NATO ally, the potential for yet another flare-up in the Middle East, more threats of tariffs, and still no resolution to any of the long-running problems, the war in Ukraine being just one example. And that was all within a single month. That said, what we are now witnessing, and this is not the first time in recent market history, is a spectacular unwinding of leveraged positions. This time, it is precious metals that are firmly in focus. Last week noted that some buyers were making portfolio allocations regardless of price, and that there was almost certainly some good old-fashioned FOMO, fear of missing out, behind the strength of the metal. Well, that observation held true for another 10% of upside by Thursday, but since then, we have seen a significant pullback in both gold and silver. Although it is worth noting that silver is now trading higher again today. The plot has thickened this morning, however. Bloomberg is reporting that a Chinese metals trader has fled the country, leaving behind a trail of unsettled trades. These trades were with counterparties involved in a ring of so-called circular trading, a practice in which the same asset is bought and sold among a group of companies to create an illusion of greater liquidity and revenue generation. These trades extend beyond gold and silver to other metals as well, copper being one of them, and copper has also been hit as a result. Initial estimates of the losses are being put at around 1 billion yuan, that is roughly 135 million US dollars, although there are suggestions the true figure could be far greater. And of course, that is just within this particular trading ring. Leveraged buyers elsewhere are also likely to feel the impact. One element of this situation in China echoes the First Brand's bankruptcy in the United States last autumn. It involves the use of factoring services, whereby cash was realized against invoices. But in some cases, there was simply nothing to deliver against those invoices. First Brands turned out not to be the first wave of what J.P. Morgan's CEO, Jamie Dimon, memorably referred to as cockroaches. So we will have to wait and see whether this latest episode turns out to be an isolated incident, or whether there are more unpleasant surprises waiting to crawl out of the woodwork. With that in mind, do not be surprised if you start to hear or read some rather alarming commentary along the lines of the end of the world is nigh, or that markets are going to crash. Moving on, another factor in the recent unwinding of gold and silver was the news that Kevin Warsh has been nominated by President Trump to be the next chairman of the Federal Reserve. This represents quite a shift from just last Monday, when his history of sitting on the hawkish side of policy decisions appeared likely to rule him out, and Rick Reeder of BlackRock was widely seen as the favorite. A potentially more hawkish stance from the chair is generally seen as reducing the risk of a more aggressive U.S. dollar devaluation, or debasement, as it is sometimes referred to, which in turn diminishes the immediate need for insurance-type assets, such as hard assets like gold. As a result, the U.S. dollar has strengthened from the low point it reached last Tuesday. That low coincided with a comment from the president himself, in which he remarked that he was entirely relaxed about a weaker dollar. Markets reacted accordingly, and then, almost immediately, Treasury Secretary Scott Bessent stepped in to state the opposite, reaffirming that the United States remained committed to a strong dollar policy. More rinse and repeat, as it were. Returning to Warsh, his path to the Fed is not necessarily a formality. There have already been threats to block his nomination until other issues in Congress have been resolved. It is also worth noting that the U.S. government is once again in a partial shutdown, although this time it is expected to last only a few days, and a funding package that carries us through to September has already been agreed in the Senate. However, assuming Warsh does get his post, the question becomes, what will he bring to the role? He appears to want to shrink the Fed's balance sheet, which is notable, given that the Fed has only recently started to expand it again, owing to liquidity risks in the overnight repurchase markets. If he follows through on that ambition, there could be some real risk involved, and the burden might fall further on the Treasury to manage the yield curve, which, for the record, has been steepening again and is now at its steepest level of this cycle. That could involve a number of measures: more front-end issuance, changes to bank regulation, or even the buying back of longer-dated issues. On the other hand, the more dovish case rests on the possibility of some sort of disinflationary productivity boom as artificial intelligence begins to permeate the wider economy, particularly if that starts to weigh on employment. None of this, though, is going to become clear anytime soon. For now, the market is pricing in no change to rates until July, and only 2 quarter-point cuts for the whole of 2026. Turning back to markets more broadly, the Q4 reporting season has been broadly okay so far. Around a third of companies have now reported, with roughly 3/4 beating on the bottom line. However, there has been a considerable difference in tone and reaction between those companies that have meaningfully exceeded analysts' expectations and those that have only met them, or, worse still, missed them. On a more positive note, global growth does appear to have been improving, and some indicators are now approaching the highs for the current cycle. Similarly, at the regional index level, most markets are in positive territory in local currency terms, France and Switzerland being the notable exceptions. On the economic data front, it is U.S. jobs week once again. The phrase most commonly being used to describe the labor market at the moment is no hire, no fire, although, it should be noted, a number of well-known businesses have recently made the headlines with job cuts of their own. Closer to home, in the UK and across Europe, both the Bank of England and the European Central Bank will be meeting this week, both on Thursday, as it happens. However, no policy changes are anticipated from either institution. Overnight, negative sentiment pushed Asian markets lower. Today, though, UK and European equities are trading higher, with the FTSE 100 currently leading the way, up around 1%. The U.S. market has just opened and is currently flat to slightly down. Oil, meanwhile, is down around 4%, following reports that talks between the United States and Iran are set to get underway, with the framework for those negotiations expected to be finalized in the coming days.
And that that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.